Hi Ayush, just let me know when to start.
Hello everyone. The Society of Finance, Economics and Business of IIT Bhubaneswar presents you the Capitalize, a highly anticipated session on high frequency trading by Mr. Ansh Tayal. Mr. Ansh Tayal, the Deputy Manager of Economic Policy and Research at NEC, National Stock Exchange, currently working as. We are glad to have him with us. Now he can proceed with his session.
Thanks for the introduction, Aman. Let me share my screen and you guys can tell me if you can see it. Just let me know if you can see my screen, please. Uh, can anyone let me know if they can, if you can see my screen?
Yes, sir. Yes, sir.
Okay. So hello everyone. As Aman mentioned, I am from NSC and today's session is all about what high frequency trading is and how can you get into this field if you are interested and what do we do using this data. So things that I'll cover today are background of high frequency trading, how has it grown over time and what has been the technological arms race in this area, what are the components of a trading system and what is the trading architecture, so that gives you a glimpse in the background of what's happening in high frequency trading, and then understanding various players in the market and how HFT impacts the market structure. And then I'll briefly talk about career prospects if you guys are interested in this field. And then the next step would be how can you build knowledge base in this area if you are interested. And at last, I'll talk about what we do using this high frequency data that I'll be talking about. So the way it will, I'll structure it is I'll take questions after every session. So you can keep posting your questions in chat while I'm on a session and I'll take it up after every session. So now to before we begin things, I just want to set the context for everyone. So briefly talk about who are the stakeholders for an exchange. So for a stock exchange, there are mainly three stakeholders. You know, there is issuer, the companies that are raising capital, they are the issuers. Then there are intermediaries. Intermediaries are your trading members or brokers through whom you trade, and then third are the investors. You and I are, for example, retail investors. There are various different types of investors. So these are three eyes, the stakeholders of a stock exchange. Now coming to various types of market participants. Now, if you look a little closer into this, various types of investors, we have retail investors like you and I. Then we have domestic institutional investors. So, for example, mutual fund, insurance companies, etc. Then you have FPIs, so foreign portfolio investors. Then there are proprietary traders. Proprietary traders are traders who trade using their own money, as opposed to DIIs or FIIs who invest on their clients' behalf. And then alternative investment funds, corporate treasuries, etc. Similarly, intermediaries, you have trading members, depository participants. Depository demat accounts are your demat accounts are opened with the depository participant, where your stocks are held in a demat form. So today's session is focused on one of the type of proprietary traders that are high frequency traders. Now coming to background for HFT. Now, does anyone recognize this place? Like you can type in the chat box if anyone recognizes. Anyone?
A stock exchange
BSc.
office.
Yes, yes. So right. So this is a picture from Business Line newspaper in 1994. So this used to be the trading floor of Bombay Stock Exchange. So you must have seen in movies as well. So there used to be a huge circle where different brokers used to have something called rings, and each ring used to have sub brokers for various trading members. So for example, one trading member used to have various sub rings, various sub brokers who used to trade on behalf of these trading members in the rings, and people used to look at each other, shout at each other, and trade uh, trade using physical securities. And but electronic trading led to the disappearance of trading pits. So once electronic trading came into the picture, these trading pits were no more, uh, did not exist anymore, because everything became electronic. How did that happen? So NSE was established in 1992 and it started operations in 1994. Because NSE became so successful because it provided a nationwide trading system using satellite communication, as opposed to the previous exchanges which were local in nature. So there used to be Calcutta Stock Exchange, Bombay Stock Exchange. There used to be more than 20 regional exchanges who used to cater to local people because they did not have nationwide connectivity. So NSE was the first one in India that brought nationwide trading system using satellite communication. Second reason, NSE was the first one to introduce automated and autonomous order matching system. So automated order matching system is the electronic trading, because of which trading pits did not exist anymore. And there was it also ensured that there was timely clearing and settlement. So the story doesn't end when you trade with when your trade matches. The final the final settlement is when the amount comes to your bank account. So that is clearing and settlement. Because NSE introduced these things which were not there before, NSE captured majority of the market share within a few years of its inception. And within 1 year of its inception, it surpassed BSE. Now, to just give you a sense of what NSE's position is today. So NSE is the largest multi-asset class exchange, uh, and it is number third in equity exchanges, and it is number one for the fifth year now in derivatives exchange, and seventh in market capitalization. You would be surprised to know. So if you look at the pin codes, so NSE investors at NSE cover 99.85% of the pin codes in this country. There are around 19,200 pin codes, and only 33 pin codes are there from which investors are not there. That is how big the reach of NSE is. So now coming to the let's take a step back and come to the global scenario. So Nasdaq was the first one to introduce electronic quotation system in 1971. So what this did was, this was the first time you could see prices on a screen. Before this, there used to be trading pits where you had to look at each other, trading members had to look at each other and decide the price. This was the first time you could see prices on a screen. And Nasdaq also set up its first data center in the same year. Now, the next step was NYSE introduced something called Designated Order Turnaround System in 1976. What this did was, it allowed brokers to route 100 shares directly to the specialists on the floor. So now in 1971, you could see prices on a screen. In 1976, the brokers could place an order in a machine that would reach the trading member on the floor. So that was another layer that was reduced. So specialists still match the order, but it did bypass the floor brokers. Now, there's another extended version of this, which was Super Dot, which allowed 100,000 shares to be routed directly. So now what happened next in 1990s, the introduction of electronic communication network was done. What this did was, this completely removed the need for a floor broker. So it provided an electronic communication network where you could directly, as a retail investor, I did not have to, go to a trading member. I could directly trade through a trading member. So I could open an account, a demat account with a trading member and directly place an order which would get matched at the exchange. So this led to the rise of online trading because now it was very easy for everyone to participate in this area. These are some examples of, ECNs. You might have heard the names. And let me look at the chat if there are any questions. Okay. So now, what are the regulatory changes that led to the that became catalyst for the rise of high frequency trading firms and the area itself? So in 2001, US stock exchanges began quoting prices in decimal instead of fractions. So what this means is there's something called tick size. Tick size is the minimum incremental amount you could trade at. So in India, for example, the tick size is 5 paisa. So either you can buy a stock at 500 rupees or you can buy a stock at 100 rupees 5 paisa. You can't buy it at 100 rupees 2 paisa. So that is the minimum tick size. So yes. Okay. So what US did was can I request all the participants to mute themselves? Yeah. Thank you. So what US did was they also reduced the tick size from 1/16th of a dollar, that is 6.25 cents, to 1 cent. Now, how does it affect high frequency traders? Now, one of the strategies that high frequency traders use is that you buy at 100 rupees and then you sell at 100 rupees 5 paisa. So you make 5 paisa on each trade. Now, if the tick size is reduced, now if the tick size is 1 paisa, you could buy at 100 rupees and sell at 100 rupees 1 paisa. So in one trade, your profit is reduced by 1/5. So now to make the same amount of profit, you will need to do multiple trades. So that gave rise to, that was an incentive for people to trade more frequently. So that was one of the catalysts. Another was the regulatory changes in 2005 SEC, Securities Exchange Commission, which is the regulator for the US markets, proposed something called Reg NMS, Regulation National Market System. What this means is that if there are multiple exchanges and you place an order at one exchange, but there's a better price available at the other exchange. So let's say I'll give you an example in Indian context. So let's say you place an order to buy a stock at 100 rupees at NSE, but it is available at 99.5 rupees at BSE. So your order will be automatically routed to BSE. So that was the Reg NMS system, which increased the competition even more. So that was another catalyst where people had to, trade more frequently to get the same amount of profits. Now, how do you we will keep talking about high frequency trading. How do you exactly define high frequency trading? So there is no formal definition of HFT. The US SEC has attributed some characteristics which define HFT. So for example, if you are using extremely sophisticated computer for generating, routing, executing orders. So let me tell you upfront that the definition of HFT is subjective in nature because who is to say what is extremely complicated and or not? But still, there are some guidelines that help you decide what is high frequency trading. Another is that if you are taking individual feeds directly from exchanges or co-located servers, and I'll talk about co-location in a bit. Then another is that you sell off very quickly. You hold your positions for a very short period of time. That is another characteristic. And then you cancel your order soon after submission because you are trying to identify other uh, people's strategy. So now SEBI allowed algorithmic trading in 2008. So now high frequency trading is a subset of algorithmic trading. And algorithmic trading, as definition suggests, that you are not manually placing an order, an algorithm is doing that for you. So SEBI allowed algorithmic trading in 2008. It initially started with something called direct market access. So in direct market access, you could directly you could directly have a connection with the exchange without having a broker in between, broker or a trading member in between. So this used to save some time because your order will now not have to be routed through a trading member's server. In 2010, SEBI introduced smart order routing. So smart order routing is is exactly similar to Reg NMS that I just explained for the US markets. So if you are placing your order through smart order routing, if you place it at NSE but there is a better price available at BSE, your order will be automatically routed. And NSE started offering co-location services in June 2010. Now, what are co-location services? Let me see if there are any questions. So co-location by definition means that you want to be as fast as possible. So what you do is you place your order closest, as close as you can to the order matching engine. So in India, for example, at NSE, order matching happens at the NSE headquarters. So it is in Bandra complex in Mumbai. So there we have the order matching servers where every order from across the country comes and gets matched. So buyers and sellers get matched. Now, if you want to have this data feed quickly available, what would you want is that you want your server to be placed as close to the order matching engine as possible so that the distance between your server and the order matching engine is shorter, and hence you would get the data a little faster. So what NSE started is offering co-location services. So within the NSE premises in Mumbai, there is a co-location service. There is a room of servers which is called co-location, where different trading members have their servers. So that it reduces uh, the amount of time it takes for the trading member server to reach the exchange, as opposed to imagine someone having a co-location service versus someone having a server sitting in Delhi. So the amount of time it will take for your order to reach from Delhi to Mumbai versus within the same premises in NSE in Mumbai, you can see the difference. And because high frequency trading is about speed, the most of the high frequency trading firms have co-location services within the have taken co-location services within the NSE premises. One more interesting point on this. So US exchanges, for example, do not allow having trading members to place their servers within the exchange premises. So what people have done is people have bought the buildings next to the exchange and have placed their servers within that building. So the idea is to be as close as possible. Then any questions on this till now? Okay, so let me go ahead.
Hello, sir. Am I audible? Am I
Yes,
audible?
yes, Ariel.
Actually, sir, due to some technical snag in our system, the participants aren't able to type their answers in the chat box. So it would be great if you could listen to their questions verbally.
Sure,
So
no worries, no worries. So
thanks a lot, sir. So if
yeah.
anybody has any questions, they may raise their hands.
So I can see one question till now. Madhumita has asks, what is routing? So routing is simply put the path for your order to reach the exchange. So let's say you are trading from your mobile. So you open your favorite accounts app, Zerodha, Grow, whichever, and when you slide that slide to buy, what happens is your order, your instruction goes to the server, Zerodha server, and then that instruction from Zerodha server goes to the exchanges server. So that is routing. So the lesser the middle points, the faster your order will get. Okay. Since there are no more questions, let me move ahead. So in the next section, I'll be, has anyone raised? Okay. So next section is growth of HFT and technological arms race. So now we'll talk about, we have covered how it began and how we have reached here. Now we'll talk about how has the growth been. So this is an example. So HFT captures a majority of the market share. This graph is a little old, but I'll show you NSE data as well. This is for US and EU. So at its peak, US had 60% of the trading in the US used to happen through HFT. And similarly for EU, the percentages were have been very high. So now coming to the Indian markets. Now who trades in the Indian markets? So this is data for cash market. Cash market is, equities. You buy or sell stocks. That's cash market, and the second type is derivatives market, where you trade futures and options. So in the cash market, if you see, there are different types of participants. There are corporates, there are DIIs, as I explained earlier in the beginning. So now if you notice, 35% of the trading happens by individual investors. So that's you and retail investors like you and I. So 35% is captured by traded by retail investors, and 27.8% is done by proprietary traders. So proprietary is, as I mentioned, people who trade their own money. So these are mostly algorithmic trading or trading high frequency trading firms. And you have 15% by foreign investors, 11% by domestic investors. So now the interesting part, if you notice in this, is in equity derivatives, the dynamics of trading have completely changed. Now nearly 60%, as I had mentioned in the previous slide as well, nearly 60% of the trading is done by proprietary traders, which are algorithmic traders and high frequency traders. And the ratio of retail investors has come down to, as compared to 35 here, it has come down to nearly 27 for individual investors, and rightly so, because derivatives are complicated products, so not many people trade in derivatives. So, and if you notice the change, so in 2008, for example, proprietary traders share used to be 25%. It has increased to 60% now. Now, this was categorization based on types of investors. Now we have categorization based on mode of trading. So are you trading via non-algo? Are you doing internet-based trading? Are you doing mobile trading, co-location, as I mentioned, and or algorithmic trading or direct market access? So here also, if you see, HFTs have majority of the share in cash market. So 33.3% is colo. So colo, of course, as I mentioned, so you would take colo because you would want your orders to be faster. So colo is a proxy for high frequency trading firms as well. So 33.8% is colo, and a part of algo trading would also be high frequency. Not all of it, but a part of it would definitely be. Another interesting thing to notice here is if you look at the share of mobile trading. So since COVID, for example, in FY 2019, the share of mobile trading has risen 4 times. So it used to be 5% in 2019, and it has come to nearly 19%. So you would have seen many articles on, there are many number of investors have been increasing significantly. So just to give you an example, in 2017, we used to have nearly 2 crore investors. And today, within span of 7 years, it has increased to nearly 9 crores now. So that is how significant the rise of investors has been. Now in equity derivatives, if you see, the share of HFTs is even larger. So 61% is co-location, and then you have 17, nearly 18% from mobile trading. So the point I'm trying to make is that HFTs capture a large part of market share in today's world, which was very low a decade ago. Now, technology has been an enabler, is a main tool for doing high frequency trading. And two main components is that you need, because you need low latency and you need latency arbitrage. So what do I mean by that? Latency is the time delay it takes for your message to reach the exchange. So because you would want your orders to be as quick, reach the exchange as quickly as possible, that's low latency. You would want as low latency as possible. And then you have latency arbitrage, which is you want to be quicker than the next guy. So that helps you make more profits. And second is you need efficient algorithms. So you can have your servers as close as a trading member or as a high frequency trader. You can have your servers as close to the exchange as possible. But if you don't have efficient algorithms, your your server will not be able to generate buy or sell uh, quick enough so that it can be placed to the exchange. So how it works is that the regular tick by tick data, every order tick by tick data is coming to your server. Your server has an algorithm that's processing it, and then it's generating a buy or sell signal. And then that buy or sell signal again goes back to the exchange's server to be executed. So you need efficiency on both parts of it. And because of these things, it has led to a technological arms race in this area. So now it has been a race to zero latency. You can read many stories about how people have spent millions of dollars to shave off 2 or 3 milliseconds because that's how important it is for them to get it right. So this is one article of that. So you might have heard of a book Flash Boys. They also talk about a similar thing. So there used to be a company called Spread Networks that spent $300 million to reduce the latency from New Jersey to Chicago by 3 milliseconds. So they spent $300 million and nearly 1.5, 2 years to reduce their latency by 3 milliseconds. And within 1 year of it, someone had come up with microwave technology, which allowed them to be even faster than that. So within 1 year, their whole setup became redundant. So that's why this area leads in technological arms race. So now people have come down to a latency of nanoseconds. So milliseconds, microseconds, nanoseconds. Now we keep talking about these numbers, but we don't really have a sense of how small they are. So just to put things in perspective, so a human eye takes around 300 milliseconds to blink. Speed of sound in air is 347 meters per second, which translates to 3 millisecond per meter. So imagine if we were doing this session in an offline setting and the distance between you and me was 10 meters, then everything I would be saying would reach you with a delay of 30 milliseconds. But we don't realize this because these numbers are so small. Now, a light takes 1 microsecond to travel from top of the Eiffel Tower to the ground. Now imagine if you somehow are at the top of the Eiffel Tower and you look at the ground. By the time the light from the ground reaches your eye, you could have placed 20 orders today. So that's how quick this is. And then a nanosecond. So light takes 1 nanosecond to travel through a length of wire of 30 centimeters. So imagine this is a wire of 30 centimeters. The amount of time for light to travel from this place to this place, that's 1 nanosecond. So that is how quick we are talking about. So now factors contributing to low latency. There are two types of, as I explained earlier, that you need efficiency on processing so that your server should be able to process data fast enough to generate buy or sell orders. So that's called processing latency. So you use FPGAs. So if you are from electronics background, you might have heard of FPGAs, field programmable arrays, or multi-core processing. So the idea with FPGA, for example, is that you remove the operating system layer, you hard code your strategies into the FPGA so that it reduces some time. So there are multiple ways to reduce processing latency. Then the second part is transmission latency. So once your algorithm is efficient, now you need to optimize on your transmission latency so that your order reaches quickly. So as I explained, people use co-located server, fiber optic, or microwave towers, different types of techniques to reduce transmission latency. But these are the two things that you need to focus on. Now coming to the third section, which will be components of a trading system. What is a trading system built of and what is the trading architecture? So any questions before that? So Sandeep is asking, is there any declination or minimal growth in proprietary trading as per graph page 24? So now the high frequency trading or colocation trading activity has been nearly consistent at about 60%. So it has grown a lot over time, but uh, it is more or less around 60%. It is not growing at the same rate, but because it is already capturing 60% of the market share, so the increase would not be linear. I hope that answers your question. So now, since any other question, you can, if you're not able to type, please feel free to turn on your mic and speak. Okay. So now moving to the next question, next section, which is components. So we have covered background of high frequency trading. Has it grown over time in India and abroad? Now, what are the components? So now, this is a 5-layer component system for a high frequency trading architecture. So now at the bottom you have network layer, which is the transmission latency. For example, I talked about, you optimize your network so that your order reaches faster. Above that you have the server hardware. So this is the FPGA layer where you optimize on the processing speed, processing part. You optimize your hardware. It does not necessarily have to be FPGAs, could be any other technology as well. Then above that, you have the kernel tuning. So as you would know, the operating system has two parts: the kernel, the raw minimum that is required to run a software, and then you have utilities. So you optimize your kernel to reduce latency. And then above that, you have programming. You program your strategies. And then at the top, you have strategies that you need to do research, back testing, and come up with strategies. So if you look at the top down of this pyramid, so first you need efficient strategies. So you do research, do back testing, and build strategies. Then you program it in low latency software. Then you optimize your kernel. Fourth, you optimize your hardware, and then fifth, you optimize your network layer. So these are the main 5 components of a trading system. Now coming to the trading architecture. So there are many sub components to it, which I'll not go into right now. The idea is to tell you a broad structure of how it works. So there are 4 parts to it. One is the your main engine, which processes and generates the result. And then you have market data adapter, which brings in real-time data from the exchange. So your data comes into the algorithmic trading engine. Algorithmic trading engine processes it and generates the buyer sell orders. Then it goes to the exchange or broker adapter. Then the confirmation of this order comes back to the trading engine, and then that is accounted for. And then again, it goes back to the data. It gets combined with the data to process it further. And also there is a storage unit where you keep storing the historical market data that comes in for further research. So this is the broad architecture of a trading system. Now, what is the trade life cycle? So this is the architecture, but that was the architecture. But now, what stages does your order go through? You might not realize it because you are just placing your order on your phone or your laptop, and you're getting a confirmation. But what happens in between? So once you place the order, your order goes to the trading member server, and there are risk management checks. For example, if you are trading in derivatives, you would need, for example, a certain level of margin that is required. So there are risk management checks at the broker's end. Then the order goes to the exchange and for matching. If your order matches, then the confirmation of trade comes to the broker, and the broker sends it to you. And then the post-trade processes begin, which is clearing and settlement. So, for example, if you have sold are shared, then the clearing and settlement team. So there is clearing team and there is settlement team. The clearing team will ensure that the shares that you have in your demat account are transferred to the person who has bought it, and you get the money. So this is a trade life cycle. So this was a trading components of a trading system architecture and the trade life cycle. Now we will talk about the structure, who are the different participants and how are they related to each other, and how does impact HFTs impact this market structure. So to understand that, let's quickly understand there are broadly two types of markets. One is core driven, second is order driven. Core driven markets are where investors trade with dealers. So you don't have a transparent order book where you can see how much someone is selling at and how much someone is buying at. You go to a dealer and the dealer tells you whether, if you want to buy 100 shares, the price will be 50 rupees, let's say. But if you want to buy 10,000 shares, it could be 49.5 rupees. So this is core driven system. So some of the exchanges, so for example Nasdaq is a core driven system, and as opposed to order driven systems where the rules match buyers and sellers, there is no dealer in between, there is no subjectivity in between. So NSC, for example, is a order driven market, so where you have rule-based buying and matching. So there is something called a limit order book using which the orders get matched. So what limit order book is, for example? So there are different types of orders that you can place, but broadly there is market order and there is limit order. So market order is when you say that you want to buy 100 shares of Reliance at whatever price that's available. So you don't worry about the price, you just want to buy 100 shares. So that's a market order. And then there is limit order where you say that you want to buy 100 shares of Reliance at, for example, 3,000 rupees. So you're placing a limit on how much, at what price do you want to buy. So that's a limit order. And using all these limit orders, a limit order book is created, which is the background of how the price changes of any stock. So for example, and this limit order book is arranged based on price time priority. So what that means is that if let's say you are offering to buy at 100 rupees, but someone else is offering to buy the same stock at 101 rupees. So his or her order would be placed above your order because that person is willing to buy at a higher price. And then same for sell side, that if you are willing to sell at a lower price, your order will be placed at the top. So now let's say the second level of this is that, let's say if the price of two stocks is same, let's say the two people who want to buy are willing to buy at the same price, then someone who has placed the order first will get the preference. So price time priority. If the price is same, then the time becomes the priority. So this is an example of an order book. So you might have also seen this on your broking platforms, which I'll show in a bit for. So this is, for example, buy side. There are two sides of a limit order book: buy side, sell side. And this is the background of how price changes. So when you place a new order, how does the trading price changes? I'll explain that in a bit. So this is the order. For example, B1 is 300 quantity at 100 rupees, then 50 quantity at 99.8. So if you notice, this is arranged in price time priority. So someone who is willing to buy at a higher price is placed higher. Someone who is willing to sell at a lower price is placed higher. So this is an example. Now let's say this is the order book for one particular stock. Now there's a new order to buy 75 shares at 100.15 rupees. So when someone has to buy 100 shares, you will have to look at whether someone is willing to sell it or not. So if you see there's someone who is willing to sell 100 shares at this price. So how will the limit order book change? Limit order, the quantity 75 orders will be executed and the quantity 25 quantity will remain. It was 100, it will 25 quantity will remain. Now let's say at this point there's a new market order to sell 200 shares. So now when someone wants to sell 200 shares, you will have to look at the buy side, and the person doesn't worry about the price because it's a market order. So whatever the best price is available, that order will be executed. So if you see the quantity 300 quantity becomes 100. So this is how a limit order book changes and the price of any stock changes. Now this is a screenshot of how it looks in reality on your broking platforms. So this is order book for ITCs, bid, orders, quantity, then offer. So if you see, this is also price time priority, higher to lower for buy side and lower to higher for sell side. Any questions on this? Because this is the core of trading. This is what happens in the background at the exchange whenever anyone places an order. So all the order gets matched at one place only, irrespective of who the type of investor is. So now coming to now that you have understood types of market and how dynamics of it changes. Now what are the different components of a market structure? So there are various types of firms, as I mentioned earlier. There are sell side firms, there are buy side pension funds, insurance funds, mutual funds. So this is the exchange. Now for people whom to whom speed matters, they do not necessarily go through a broker. They want a direct line because so that their order reaches faster. So let's say hedge funds. So hedge funds also sometimes might need to trade quickly. So they also can have a direct line. There are brokers who obviously connected to the exchange. Then there are proprietary traders. Then there is sometimes investment banks, prop desks are also do also have direct access to this. Now, for example, mutual funds. Mutual funds do not necessarily need to trade at a high frequency because they are the idea of mutual fund is for long-term investment. So they do not trade to make quick money. They do not invest for short term. That's why they go through a broker. Similarly, for retail investors, they also go through a broker. So this is the market dynamics. Now, factors considered in market microstructure. So you may or may not have heard this term, market microstructure, but so market microstructure is a field of study in economics that examines how the trading behavior of different participants changes under different trading mechanisms. So for example, in quote-driven market versus order-driven market, how does trading behavior of prop traders, high frequency traders change? Or for example, how does behavior of retail investors change? And how is it different from each other? So these are the different types of, just to give you a quick overview, these are the different types of variables that market microstructure looks at. So there are mainly two types, two categories, which is you look on the basis of trading mechanism. So you have market type, as I mentioned, order driven or quote driven. Then you have trading sessions. So let's say currently NSE trades from 9:15 to 3:30, but commodity exchanges trade till 11:30. So how does behavior of participants change based on trading sessions? Order forms, there are different types of orders: market order, limit order. So you can explore further. There are different iceberg orders, there are immediate or cancel, fill or kill, different types of orders. Then there is transparency, whether you have anonymous order book, or do you know who is buying or selling. Similarly, on this side, you have order priority, whether it's price time priority or price volume time priority. If someone is placing more number of orders, will that be preferred? Then there's tick size. So as I initially mentioned, 5 paisa. Why should tick size be 5 paisa? Why not 1 paisa? Why not 10 paisa? So these are the questions that market microstructure looks at. And yeah, this is what I'll also talk about later. This is what we work on. So as an exchange, we look at this data to we don't build strategies using this data because that's not our job. We use this data to understand the market dynamics and how, to make the platform efficient. Now, presence of HFTs have multiple benefits. So it reduces bid-ask spread. So let's say if HFTs were not there, then the best bid is the best price someone is willing to buy at 100 rupees, let's say, and the best ask is the best price someone is willing to sell at. So 100 rupees, 10 paisa. So people have claimed that presence of HFT has reduced this bid-ask spread. So there's more liquidity in the market. So more orders mean more liquidity, reduced impact cost. Impact cost is a very important concept in this area, which I'll talk about in EPR projects as well. So impact cost is the cost that you are paying for uh, buying something. So let's say the best buy price was 100 rupees and the best ask was 101 rupees. So the midpoint of this is 100.5, right? And if let's say you were able to buy 100 shares at 101 rupee, so the 50 paisa is your impact cost. Impact cost by definition means that the impact that you have when you place a big order. So reduce impact cost. However, so again, you might have heard or seen stories, documentaries on this flash crash. So what happened on 6th May 2010 was Dow Jones Industrial fell by nearly 10% and came back to its normal level within a period of half an hour. So this was a huge moment when people, started to look look towards the regulatory perspective of high frequency trading, because a lot of people attributed this crash to high frequency traders, that because of them this happened. So that is the time where SEC started really looking into the regulations, making stringent regulations for high frequency traders. Now HFT also has certain criticisms. So one of the criticism, for example, is that it increases volatility. So the idea is that during the times of crisis, when markets are going down, when there's liquidity is required, the firms are not there. They also do not trade. And then disadvantage to small investors, that these guys get faster access to it, but other people do not have. And then same for institutional investors, that because they do not have quicker access to it, and then market inefficiency. Now, yes, this was the main content about high frequency trading. Now, before I jump into the career prospects and what we do using this data, any questions, please? You can turn on your mic and speak as well if you're not able to type. No questions? Okay, so let me move ahead. So if till this point you have, you might have heard of high frequency trading firms or HFTs. So if you are interested in this area, then what are the career prospects for you? So prospective opportunities are, one is of course, you become a part of HFT firms who build these strategies and trade on it. So these are some of the examples. Then second prospective area is the exchange. So you become part of the exchange and you look at the same data but from a different perspectives, from a different perspective. So HFT guys would look at it from building trading strategies. You as an exchange would look at it in terms of making platform efficient and understanding different behavior of different market participants. And third is you can be part of the regulators team. So you can so as a regulator, you need a skill set in this area because you are forming regulations for HFTs and other trade market participants. So having understanding of market microstructure and high frequency trading would help you in building more thoughtful regulations. And fourth is, of course, you can be in academia working, doing research in this area. So these are the because this is a very niche field, so these are the four prospective types of opportunities you have. And then just to quickly give you a glimpse of it. So this is the same trading components that we saw. Now, different roles at trading firms. You might have heard of, quant developers, quant traders, researchers, etc. So each layer, needs a specialized person. So at the network layer, for example, you would have a network engineer. Server hardware layer, you would have a FPGA engineer. Then see the programming in the optimizing kernel optimizing part, you would need quant developer, which is also, software developer who has an understanding of this area. And then you at the top you have quant researchers. Researchers are people who, because the data size is huge, you also need to know programming because for backtesting purposes you would need it. So people who do backtesting and come up with trading strategies, that's quant researcher. And at the last you have quant traders. Traders are the, frontline, are at the front line who are trading and monitoring these algorithms and strategies. So these are the different roles within HFT firm. Some of the popular firms you would have heard of. Now, now that you have understood the career prospects, how do you build knowledge base to get into this area? So the first very important point is that you need to have understanding of financial products, so derivatives. So you might know what a call option or a put option is. You might know, what a call spread or put spread is, but practical understanding of this data is very crucial. So for example, in derivatives, just to quickly give you a sense of the numbers. So there are at NSE, there are around 90,000 products available in derivatives. Now you should know what I mean when I say 90,000 product, or what I mean when I say product. So for example, in option, a product is defined as the combination of the underlying. So let's say a bank nifty is an index, bank nifty call option with a strike price of 45,000 expiring in the coming week. That's a unique combination of a product. So this is one product. A put option on the same thing is a different product. Similarly, we have 90,000 products, nearly 90,000 products that trade. And out of 90,000, around 17, 18,000 trade on a regular basis. So understanding the practical understanding of this is very crucial. And second part is understanding of the trading process. So the process that I briefly explained in this presentation. So understanding of limit order books, how limit order books work, how does the dynamic of limit order book changes during the volatile period versus a regular period. So because this is at the bottom line, this is the trading process. This is how the price changes for any stock or for any product. Now, third is programming, because now why is programming required in this? Programming is required because the size of the data is so huge that it's not possible to work on it in any other format. To give you some perspective, one day cash market data. Cash market is equity buying or selling. One day cash market data at NSE has around 800 million orders in a day. So we get 800 million orders in a day, 80 crore. And the data size of this is nearly 400 GB. So one day's data is 400 GB. How do you even, how can you even imagine processing it? Similarly, for derivatives, the data goes to 4 terabytes, which I'll come to in a bit. And the fourth important part that is required that will be useful for you guys is that you need to learn how to work with large data sets. It doesn't necessarily have to be this market data, because this is not publicly available. The tick by tick, the high frequency data is not publicly available, but you learn to work with any type of large data sets because the knowledge is transferable. The idea is that how do you deal with one file which is 800 GB, because your machine would have RAM of 16 GB, 32 GB, 64 GB. How do you work with that? So that's very important. Now coming to some of the books, this is of course not an exhaustive list, but some of the books that I found interesting. So Flash Boys, for example, the one I was talking about. Then there's Dark Pools, which is on similar topic. And there is Capital Ideas. Capital Ideas is a book that tells the story of how the ideas from academia came into the corporate world in the late 1900s. And then you have For example, my life as a quant. This is a combination of textbook as well as storybook. So Emmanuel Derman was one of the first physicists to move to uh, finance field, and how has his journey been. Similarly, Nerds on Wall Street is about math, machines, and wired markets. So explore these books as well. Then you have blogs and conferences, some of the blogs that you can follow, that will keep you updated about the industry. Because so there are two parts to it. One is having the technical knowledge, and second is having an overall understanding of the industry, or and what's happening in the industry. So this will be useful for that. Now, coming to, I know it's already 8, so I'll take 15 more minutes. So now coming to what we do at NSE. So to give you a sense of the data, the number of messages, as I was mentioning, have increased from 2 billion. 2 billion is 200 crores in 2017 to 1400 crores in 2024. So one day's data in one day, single day, we get 1400 crore orders in derivatives. The order matching engines. So the matching engine that I told you, key, that different all the orders come to this order matching engine where they are matched. So the number of order matching engines have increased 3 times in the last 3 years. So the way it works is that there are n number of order matching engines, and different products are traded on different matching engines. So let's say all the products of Nifty are traded on one server. All the products of Bank Nifty are traded on a different server. Because we get such high volumes, there are n number of order matching engines that are available, so that the model is vertically scalable. Now, this I've already mentioned, one day's futures and option data is around 3 terabytes, 8 billion, which has now become 14 billion, and similarly 800 GB of data for cash market. So now today we have timestamps available in nanoseconds. So the amount of data we work with, it was required that we have, microsecond, millisecond was not enough. So we have nanoseconds now, and tick by tick. So this all the uh, data. So every order. So if you take data which has every order that has come in throughout the day, this is called tick by tick data. That every tick is captured, and it is available in jiffies. Now, what is a jiffy? So 1 second has 65,536 data points. Just 1 second. So that's a jiffy. 65,000 jiffies. So that is the amount of data that we work with on a daily basis, that I work with on a daily basis. Now, again, this is the same, order matching engine. We have now 16 order matching engines, 16 servers on which these products are traded. We have 4 terabytes per day. Daily average turnover has increased to 1.5 lakh crore in a day. So these numbers are, mind boggling, and you should. Now, coming to how do we work with this data? So we have a huge server that has 224 processors and 900 GB of RAM. So even though this is also not enough for one day's data, but we use high performance computing in a Linux based environment to work with this data. So we have a ecosystem of R programming, C++, Julia, and on a Linux based operating system, we also write shell scripts, etc., to work with this data. This is the computational capabilities that we have. Now, to give you might ask, tick by tick data is fine, but what does it look like? When I got to know about it first, I also wanted to see what it looks like. So for example, this is what it looks like. This is one order entry. So this is a sample of 1700 orders. So one order entry. So this is the transaction time. If you notice, 0900, this is pre-market orders. 0900, 11 seconds, 0.068176. So this is timestamp till microsecond. And this is a unique order number that is available in the record. Then what was the limit price? So what price the person wanted to buy at, and trigger the various. So this data, this 1400 crore orders, we have 74 columns, 74 different variables. I've just shown you a sample of it. 74 columns where we work with which has different information about one particular order. So let's say whether it was a market order or not, and what was the type, was it a buy order or a sell order, what was the snap time. Snap time is this is not part of the raw data, this we have added. So this is what the raw data, this is what tick by tick data looks like. So 1700 ticks. Now visualizing demand supply. So if you look at demand supply for at any given point, you would want to see, right? At 9:15, let's say what this graph tells me is for Reliance Industry on 22nd November 2022, this was the demand on the this was the demand and this was the supply. So people who are willing to sell and people who are willing to buy. So one of the important things that you would notice in this is how the demand supply dynamics are different in a limit order book. And this is one of the very critical things, critical research areas in market microstructure that you understand, as I mentioned earlier, that you need an understanding of the limit order book. So this is the cumulative sum of, on the buy side as well as the sell side. So if you see the slope for buy orders is much higher than the sell orders, and sell order book is much deeper because it is going till 1 million orders, for example, at 9:15. So buy and sell side dynamics are different. So here buying pressure is more, for example. Similarly, the same thing at 11:15. Now it spreads out. So buy order spreads out, and this is real data built using real data in R that we have done. So similarly, now multiple periods. So this is how it changes during the day. So this was at 9:15, then it changed to 11:15, 1:15, 3:15. So this gives you a glimpse of how trading activity order book of a particular stock changes. Now, another project, for example, that we have done is that we have to do capacity planning for these order matching engines. As I mentioned, that order matching engines have been increasing exponentially. It has increased, they have increased 3x in the last 3 years. So today we have 16 order matching engines for futures and options. So one of the projects that we did is we took this second level data, every second how many orders do we get, and we forecasted how many orders will we get in the next month, so that the tech team, it helped the tech team to plan for for the next month, because they, whether they want to shift one product to the other, if there's load, if there's more load on uh, one order matching engine. So this forecast helps them to plan for the next 2 months and higher. Uh, Now, third, one other more project that I want to mention is that impact cost, as I mentioned earlier. So if you see, impact cost also is not symmetrically distributed. It varies for buy and sell side. So this is impact cost in percentage point, for example, 0.03 percentage impact cost for SBI, and for HDFC 0.04. However, if you notice, this is different for buy side and sell side. So when you have higher impact cost on, let's say, sell side, that means that there is low liquidity on sell side, because if there is higher liquidity, the impact cost would be lower because there would be more people willing to sell. So understanding this, for example, impact cost, if you see at a larger scale, -10 to 10, you might not be able to differentiate what's going on within this because it all looks like a straight line. However, if you zoom in, see, so this is impact cost at various order sizes. Let's say, because impact cost is dependent on order size, right? So 1 lakh order, if you want to buy something of 1 lakh, what will be the impact cost versus something you want to buy at 2 lakh? Let's say you want to buy 1 lakh quantity of something versus 2 lakh quantity of something. So 1 lakh quantity would have a lower impact cost naturally because you're buying less. So it would the effect would be less. So if you see for different stocks, the behavior is quite different. For buy side, the positive impact cost is buy side, the negative is sell side. So this is another important area to understand impact cost of various products. So one practical implication for this is there are the margin requirements for different products is decided. One of the factors for deciding it is impact cost. So if the impact cost of a stock is lower, the margins required for that for trading in that stock would also be lower. This is all using tick by tick data and parallel processing that we do. Now coming to what other research that we have as economic policy and research team. So we have a monthly publication called Market Pulse, where we cover macro and markets data, and a lot of NSE related private data is published on a monthly basis. And some of the glimpse I showed you in this presentation, but you can look up this monthly publication on the website as well. And we also have a research initiative 2.0, where we have, where we support research, where we give research grants based on proposals. So if you are interested, please, look it up. So you can go to NSC homepage and just go to the research section, and you will find all the things, Market Pulse, research initiative, and all the research work that we do at NSC. So yeah, and this is the team that makes all this possible. So yeah, that's my presentation. So, and you can reach out to us at dleprall@nsc.co.in in case of any queries, and I'm happy to answer any questions even after the session. If you have, you can write to me. So any questions right now, I'm happy to take. Okay, so I hope this has given you a good introduction to what high frequency trading is, and I encourage you to explore more if you are interested in this area. I've given you a starting point with this presentation. I hope it has helped you all. Amit, Ayush, over to you.
Thanks a lot, sir, for presiding this session. Our society is glad that we could have us with you, and we would like to collaborate in future with you too for such wonderful sessions. It was an exciting session, and we learned a lot, we enjoyed a lot, and definitely I think that many people would have been interested in high frequency trading, and the guidance which you have provided would turn out to be much helpful for them in the future. So thanks a lot for this session.
Okay, thank you everyone.